The topic of today's video was originally about the US dollar index breaking the 98 mark. Ironically, just before starting this video, I received news that the dollar index had actually dropped below 98 and was hovering in the low 97s. This is quite alarming, as it indicates concurrent issues with both the US dollar and US Treasury bonds. It seems that Trump's erratic actions have failed to win support. His move to potentially fire Jerome Powell, in particular, has heightened risk aversion among investors. As a result, capital has flowed into safer havens like gold, as well as financial markets in Japan and Europe. It's important to clarify that when I mention other countries' markets, I'm referring specifically to Japan and Europe, not the so-called Great Motherland touted by some nationalistic individuals. This shift makes sense, with the US appearing unreliable and China, as the other party in ongoing trade tensions, also seen as a risky bet. Japan and Europe, which have remained relatively uninvolved in the conflict, have become more appealing destinations for capital. Additionally, foreign investors face restrictions on purchasing Chinese government bonds. While corporate bonds are available, they come with significant risks, deterring most investors. Meanwhile, gold investors must be celebrating with prices surging by 1% in a single day, far outpacing the annual 2.8% return of regular bank deposits. So, what exactly do fluctuations in the dollar index mean? The dollar index reflects the market's collective assessment of the current and future value of the US dollar. Although it's not the same as the dollar exchange rate, its movements significantly influence international dollar exchange rates. The recent surge in gold prices can be explained by global uncertainty. As countries debate which currency to stockpile for future trade, they're hesitant to take sides. The euro and the yen have their own problems. The eurozone is grappling with economic stagnation, Italy's debt crisis remains unresolved, and Germany is experiencing a sharp drop in factory orders. The yen, on the other hand, has been heavily printed by the Bank of Japan, leading to significant devaluation. The Chinese yuan, while rapidly internationalizing, still has restrictions on capital flow and remains closely tied to the US dollar. Cryptocurrencies like Bitcoin are too volatile to be relied upon in times of crisis. Gold, with its millennia-long history as a reliable store of value, unaffected by any single country's creditworthiness, ability to hedge against inflation, and high liquidity with a daily global trading volume exceeding $200 billion, has emerged as the top choice. It's crucial to note that the dollar index has plummeted from 110 to below 98, a drop of over 10%. What makes this even more astonishing is that this decline occurred despite the Federal Reserve's hawkish stance and refusal to cut interest rates. If the Fed were to lower rates, the dollar index could easily sink further, possibly reaching around 95. The dollar index is calculated based on a basket of currencies, including the Canadian dollar, Japanese yen, euro, British pound, Swiss franc, and Swedish krona. Given that the US has extensive trade ties with Europe and Japan, a sharp drop in the dollar index means that the cost of US imports from these regions is rising rapidly. For a country as import-dependent as the US, this is a dire sign. Witnessing the dollar index's rapid decline, one can't help but blame Trump's actions. Instead of weakening China, he may end up collapsing his own economy. This situation reeks of a dollar credibility crisis. If he continues down this path, a full-blown dollar crisis could be imminent. Although it's still too early to assess the full impact of Trump's tariff policies on the US economy, market pessimism is at an all-time high, suggesting that the global financial crisis may already be underway. Let's recall the Smoot, Holy Tariff Act under President Hoover. That policy led to a drastic reduction in global trade volume. Will Trump follow the same path? A sharp contraction in global trade would be disastrous for the US dollar. In fact, countries are already reducing their reliance on the dollar in international trade. Why? The US has a history of weaponizing its financial power, freezing the foreign exchange reserves of countries like Iran and Russia. This has made other nations wary. Russia has slashed the dollar's share in its foreign exchange reserves from 45% to a mere 3%. China is negotiating yuan-denominated oil deals with Saudi Arabia and Brazil, bypassing the dollar and even the SWIFT system in favor of China's CIPS system or bilateral currency swap agreements. Think of the US dollar as the world's economic fire extinguisher. In the past, during economic crises, everyone rushed to hold dollars for safety. But now, with the fire extinguisher leaking and losing its effectiveness, investors are dumping US Treasury bonds and stocks, causing the dollar's appeal to fade. US Treasury bonds face a similar fate. If, after a year, the purchasing power of a Treasury bond is only half that of the euro, would you choose to convert it into euros or hold onto the bond? If the tariff war persists, the dollar's purchasing power will decline even further, increasing the risks associated with Treasury bonds. It's no wonder that international investors are distancing themselves from US debt. It's simple common sense. One has to wonder, is Trump deliberately sabotaging US Treasury bonds, or has he secretly bet on rising gold prices? If Trump continues his tariff war, the world may abandon US dollar-denominated assets en masse, triggering a devastating triple whammy of stock, bond, and currency crash. For Trump, there's an urgent issue at hand. A large number of US Treasury bonds are set to mature in June. To maintain fiscal flexibility, he needs to lower interest rates before then. Otherwise, if he resorts to issuing more short-term, high-interest rate bonds to pay off existing debt in June, the long-term financial outlook for the US will be bleak. It should be noted that the content above contains a significant amount of subjective speculation and some inaccurate views. The global economic and financial situation is complex, and currency and financial market fluctuations are influenced by multiple factors. Now, here's the crux of the problem. After Trump initiated the tariff war, market forecasts indicate that from May to July, soaring import prices will trigger widespread inflation across all sectors of American society. Facing such a scenario, the Federal Reserve will undoubtedly be reluctant to cut interest rates. Just consider the current interest rates on US Treasury bonds. And what about credit card interest rates? I imagine the average American is under immense financial pressure right now. It's baffling that they still support Trump. Any rational person would be working to stabilize the market before June, creating expectations of a decline in the CPI and future rate cuts. They'd be pulling out all the stop sweet, talking and cajoling the Federal Reserve into lowering rates quickly, ensuring they can sell a substantial amount of bonds when it's time to issue new debt, and only then resume the tariff war. But Trump has managed to overlap the peak bond maturity period, when interest rates desperately need to be cut, with the inflation rebound, when rates should be raised. It's almost as if no one on his team anticipated the looming crisis in June. Trump's recent actions betray his growing panic. First, he personally met with Japan's trade representative, Akasawa Ryo, who is just a minister, not a high-profile figure like the finance or foreign minister. Then, he dispatched the Secretary of State to Europe and Robert Lighthizer to India. If 75 countries were truly lining up to negotiate with him, there'd be no need to send top officials scrambling around the globe. Clearly, most countries see Trump's actions as a dead end and are waiting to watch the spectacle unfold. So, Trump has no choice but to take the initiative and seek out negotiations. That's why I'm not at all surprised to hear that he's already setting up a task force to deal with the potential fallout from his tariffs on China. Since the start of the trade war, China, being on the front line of this confrontation with the US, has seen its exchange rate increase only marginally, by about 3 to 5%. In contrast, the euro and the yen have been far more volatile, with the euro rising by over 18% and the yen climbing by 13 to 15%. Still, the fact that China's exchange rate has appreciated despite standing tough against the US, while the dollar has depreciated across the board, is telling. It suggests that although global capital isn't overly optimistic about the yuan for now, they do believe China has a good chance of coming out on top in this showdown with the US. Remember, financial markets are driven by some of the most perceptive, rational, and well-informed players in the world. Their current capital flow decisions offer a glimpse into the likely trajectory of the US-China trade war. In the coming months, several major negative shocks are likely to hit the US. What could they be? It's almost too staggering to imagine. With $6 trillion in US Treasury bonds maturing in June, on top of the $9 trillion due this year, and prices set to skyrocket once the US inventory runs out in a couple of months, what will become of the dollar, Treasury bonds, and the stock market? In my view, the concurrent troubles with the dollar and US Treasury bonds can be summed up simply. Investors are in a frenzy, constantly selling off Treasury bonds for dollars, only to turn around and swap those dollars for gold, euros, yen, or German bonds. Everyone's terrified that Trump, in a bid to bring manufacturing back to the US and solve the debt problem, will deliberately devalue the dollar. While such a move would amount to defaulting on debt and severely damage America's credibility, something no other president would dare, Trump, known for his unpredictability, might just do it. I previously said that Buffett's decision to clear his holdings was a matter of timing, exiting the stock market while it was unstable and planning to re-enter once the dust settled. The situation with the dollar is similar now. Many investors are biding their time, seeking refuge in gold or other currencies until the storm passes. But the big question remains, how long will Trump keep up this erratic behavior? No one knows. The dollar index breaking the 98 mark was just the beginning. At this rate, 95 could be just around the corner. Why is Trump pushing things to the brink? By hinting that the US is running out of money and on the verge of defaulting on its debt, he's essentially playing a high-stakes game, betting that investors will have no choice but to bail him out since they believe there's no other place to park their money besides US stocks and bonds. But will they? Will the Federal Reserve cut rates? There's a real possibility that the entire world has reached a tipping point, thinking, I'd rather take a short-term loss if it means getting rid of Trump, because the alternative could be catastrophic. If that's the case, no one will come to his rescue, and the Federal Reserve might hold firm on rates, willing to go down with the ship. So, what's Trump's next move? Will he suddenly declare an end to the tariff war? Well, folks, that's all for today. See you next time.